Yeah, that's because, while quite a few Indians can find China on the map of the world, but I don't think more than 1% of the country can find Greece on the map of the world. So, Greece, in my view, was a non-issue as far as India was concerned. I thought it was a reasonably serious issue for the countries around Greece, which is basically the Eurozone. But also at the back of my mind, I was fairly certain that some deal would be struck, and that's really what has happened because they cannot let a first world country go down, and there are a lot of posturing, etc., etc. But it panned out along expected lines, and I think that was also the consensus. China, on the other hand, was a mad bull market and has been a mad bear market as well. Again, China market going up 150% had no ripple effect on any other market. No market in the last 12 months has gone up 150%. So it's coming down 30% again has had no impact on the rest of the world because when you participate on the upside, you will participate on the downside. But when you sat out that upside, you will sit out the downside too. So both these events, while they might be very significant for their own economies, they haven't affected really the global sentiment towards equities. But what it has done is that there is talk that the Fed may not want to raise interest rates this year as a result of this turmoil, which again is helpful for equities.
You're absolutely right because less than 2% of China A shares are actually owned by foreigners. So
there's a quota.
There's a quota for that. So even though it's a massive wealth erosion of about $3 trillion, that's only restricted to the local Chinese.
Well, it's not insignificant in the sense that if you look at consumption from China and companies that were benefiting from consumption of China will be affected. I mean, that there is no doubt about. But to extrapolate that and say there's a global recession that can happen or a big slowdown, I mean, that probably is a bit excessive.
Last time when we saw such a massive wealth erosion, purely in terms of numbers and in trillions of dollars, was in 2008. And that time you went on record and you said that globally India cannot move in an isolated manner. Everything is connected. But this time, even though we are staring at a lot of global noise,
it's not global. I mean, that's exactly what I'm saying. It wasn't global. It was very, very isolated to two countries. And one was a very small economy. And the other is a large economy, but then very local centered collapse in the markets. But the US didn't collapse. So the entire, 2008 was completely different. It's not even remotely comparable to these two events that have happened in the last 1 month. Not at all.
But on the margin, do you think the strength in equities is here to stay? And when I say strength in equities, I just don't mean Indian equities. Global equities have done remarkably well. Nasdaq is sitting at 5,000. S&P is not far away from an all-time high. We are less than 10% from an all-time high. European markets also have done rather well this year.
Very well. Japan has been doing beautifully. Well, the fact of the matter is a very simple trade in equities. As long as you keep interest rates low, equities do well. Now, rest of the world has already gone to the zero interest rate situation many years back. In India, the expectation is that we will not go to zero, but we'll definitely come down from where we are. I mean, it's debatable whether that happens this year or next year, but the trajectory of rates has to come down. So India always runs ahead in anticipation. So I think the global environment for equities relative to any other asset class, if you take commodities, they have been killed. And incrementally, they were killed because of China. But even before this Chinese event happened, commodities had been falling last 12 months, 18 months, right? Ever since actually the dollar started to rally. So if you look at commodities, that's not a place you want to be. If you look at treasuries again, or fixed income, I mean, the yields are just so low that you'll be absolutely nuts to be buying fixed income in today's environment in most parts of the world. Real estate, in particular in India, has really, the bottom has fallen out. So, I mean, what else is left? And ultimately, in the pie chart of investment, out of these four major classes, money will keep moving from one to the other. The three being out of the equation, the fourth one left is equities. And therefore, in India, you've seen massive inflows into equities from domestic investors. So I think it's purely just a tactical shift and not difficult to understand.
And if I look at that pie chart for equities, within that pie chart also, emerging markets are in stress and India clearly seems to be in a pole position. The basic definition of brick now has got disintegrated.
Yeah, because this keeps changing. I mean, 2 years back, people said that Indonesia...
Take India out, put Indonesia.
Put Indonesia in, and the same fools are now saying that, entire BRICS should go and only India should remain. And this is all nonsense anyway, and I don't know why people listen to these people who write such rubbish reports. That said, India will always benefit when there is global turmoil. I mean, that we have seen historically, by and large, unless it's a Six Sigma event like 2008. But otherwise, in the Asian crisis, India was quite resilient. In the 2001 meltdown, only the tech part of India suffered. The rest of the market actually did quite well. The industrials did very well. And now also, since this whole crisis in China and Greece have happened, I mean, India has been very resilient because Indian market is a well-balanced market. So, I mean, it's very commonsensical for money to move into India when turmoil happens elsewhere.
Now, the first half of this calendar year has been tough and volatile for Indian markets. Nifty or Sensex, they've done literally nothing, 2 or 3% here or there. Can the second half be much better and significantly better?
It appears so because for one major reason, which is that I do expect that the lagged effect of the government's attempt to revive the economy through spending its own money will begin to have some effect. You know, I don't think it will be a huge effect, but markets don't require huge effect to make the turn. What you need to see is if it was even a small delta can change the trajectory of markets. And I do think second half numbers might be a tad better than what we saw in the first half.
So are we on course to make a new high very soon?
I think many stocks are already making highs. I mean, you're being weighed down by many other stocks on the Nifty side, but I have been very bullish on small caps and mid caps. I mean, that's been the segment I've been amazingly bullish on. And if you see that, I mean, they don't seem to be suffering any bear market at all. I mean, even in the falls that we've seen in India, usually the mid cap index has been flattish, while Bank X might be down 1% or Nifty might be down 1.5%. Small caps will typically just completely fall flat in such meltdowns, you know, as if nothing matters. So that is telling you that there's a stealth bull market already on. Okay, it may not be very apparent if you look at Nifty, but it's definitely apparent when you go one inch below the Nifty.
So this market is not a mature bull market. This is still a young and a vibrant bull market.
I don't think it's mature as far as the small and mids are concerned. It's very mature in my view as far as large caps are concerned. And you know, my view is that large caps are not going to give you more than 10-15% on an aggregate basis. Now that might be great for mutual funds, but that's not great for me. I mean, where fixed income is yielding you 8 to 10%, 15% doesn't excite me. But small caps and mid caps, you can make 100%. And I don't want to enter market looking to make 15%. I'm sorry. If I have to enter the market, I want to make 100%. I don't see that happening in any of the mainline stocks, but I definitely see that happening in the smaller.
So on a 3-year basis, you don't think any Nifty 50 stock could be up by 100%?
Up 100%?
In 3 years?
I really doubt it.
Even banks?
I really doubt it.
You've liked PSU banks in the past, you've disliked them, then you've liked them, and you've disliked them. Yeah. So what is the...
No, I don't
what
like
is stance
them.
right now?
I don't like them right now.
Why is that?
I mean, in the sense that I think there is plenty of other places, even in the large caps, where you can make reasonable return with a little bit less risk. PSU banks, I think the NPA problem still exists. I don't think that's gone away, and I do believe that capital infusions being talked about are vastly underestimated. So there's going to be a permanent pressure on the balance sheet for a while to come. So, you know, I think there are far, far better places, even in the large caps, where you can, you know, safely play and, you know, make your garden variety 15%, if that's what excites you.
So what is on your list if somebody is looking at 15%, 17% returns?
It's the usual suspects, Nikunj. I mean, nothing extraordinary. It's the same old, I mean, ultimately you have 50 stocks, out of which 30 stocks are not worth talking about. It just comes back to the same old 20 stocks which have done very well. And, you know, I'm sure the autos, which had, particularly the two-wheelers, which had a bit of a rough ride, I think that's, again, probably behind them. So I like two-wheelers. I like Bajaj Auto and I like Hero Honda. So those, and Maruti, of course, has been a favorite for many years. Continue to like it. But don't ask me to like, you know, a Reliance or...
You've never liked it?
Yes, if you take a 25-year snapshot in the market, then I don't think I've liked it for more than a few months.
Even though GRMs have stabilized, Reliance Jio launches around the corner, you're not very impressed with the roadmap?
I just think there are far better ways to spend your money. You know, it's an index stock, so for some people it's a mandatory weighting, whether at the market weight or lower. But, you know, from my perspective, it is...
What is so special about Maruti at 25 times 1 year forward? It is expensive.
In India, nothing quality is cheap, unfortunately. Even in mid caps and small caps, any company with a even basics of a brand in place are all 40, 50, 60 times earnings. And La Opala Glassware, which is a very good company in my view, is what, 50, 60 times earnings. I mean, so...
But they're growing.
That they're growing. So is Maruti. So India is not going to be cheap for branded companies.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.